SoFi has been generating some buzz lately with its recent acquisition of Technisys. Rumors about SoFi stock dilution came immediately after the company officially announced its acquisition of Technisys, specifically on its mode of acquisition. In its official press release, SoFi stated Technisys shareholders will receive aggregate consideration of approximately 84 million shares of SoFi common stock, less than 10% of SoFi's fully diluted share count as of September 30th, 2021, subject to customary adjustments set forth in the merger agreement. Now, will this acquisition lead to another stock dilution? Stay tuned until the end of this video to find out how SoFi's latest acquisition will affect the company as discussed by SoFi CEO Anthony Noto during their SoFi acquisition of Technisys conference call. We'll also shed some light as to how the warrant redemption last December 2021 could possibly affect SoFi's Q4 earnings call. Hello and welcome to Wealth Gambit. On this channel, we cover the latest stock trends and research. If you like that type of content, be sure to smash that like button for the YouTube algorithm and subscribe so you're updated as soon as we upload new videos. Just a disclaimer though, we are not financial advisors and none of this is financial advice, so always do your own due diligence. Shouts out to last week's top comment from Pedro Costa. Thank you for watching and commenting on our video. You're a real one. Without further ado, let's get right into it. The all-stock deal valued at $1.1 billion that SoFi had recently entered into had turned some of its retail investors a little scared due to the fact that the acquisition would cause further stock dilution. A news article by Motley Fool published on February 25th, 2022 states that this transaction will dilute shares. So how does this affect us SoFi longs in this recent SoFi acquisition? As promised, here is SoFi CEO Anthony Noto discussing how Technisys acquisition will help the ultimate SoFi strategy in becoming a one-stop shop financial services productivity loop.
Overall, which will drive more adoption for the industry in which we participate. Strategically, Technisys is a critical step forward in positioning SoFi to improve all three core elements of our FSPL strategy: best-of-breed products with superior unit economics and an investment in technology as we build the AWS of Fintech that is also driving attractive returns as a business. There are many anticipated synergies to point to from the planned combination of the companies that are a result of our strategy. I'd like to highlight four of them. First, Technisys Cyberbank platform is strategically critical for SoFi banking, credit card, and other new products. SoFi currently uses third-party banking core and ledger for checking and savings. SoFi's credit card is on an entirely different separate core and ledger as well. As we considered moving to a more modern banking cloud native architecture for checking and savings to ensure we could continue to scale our strategy of best-of-breed products with superior unit economics, we realized the strategic importance of having one cloud-based core integrated with processing. After evaluating several potential choices, including building our own, we concluded that buying Technisys was the best strategic choice as it uniquely is extensible, customizable, and supports multiple products in one core. And like Galileo, it's an attractive, fast-growing business. We expect that both SoFi Checking and Savings and SoFi Credit Card will migrate to Technisys core platform in the next 2 to 4 years. This move will advance SoFi's Better Together strategy by enabling faster innovation, more real-time decisioning, and a high degree of personalization. The move is also expected to save $75 to $85 million cumulatively through year-end 2025 and $60 to $70 million annually thereafter. The acquisition allows SoFi to expand its lead as a one-stop super app by migrating to one core, and new products from SoFi will be built day one on Technisys. Second synergy, we will gain synergies by selling Technisys to Galileo's existing 100-plus partners and their 89 million enabled accounts. In evaluating SoFi's needs, we concluded that many Galileo partners would also need an extensible, customizable multi-core product. The vast majority of Galileo's existing partners want to offer lending, credit cards, rewards, and many other products, but they can't extend their current core. Building separate cores for new products risks the same siloed issues we see in legacy banks, and architecturally would be a step backwards. In expanding from one to many products, these partners will also need to migrate to a multi-product core like Technisys. As important, vertically integrating their multi-core and processing into one stack with one partner should provide companies a technology and data strategic advantage, as well as substantial cost savings. Additionally, Technisys' Cyberbank platform is cloud native and supports the integration of third-party technologies via Technisys Marketplace. This allows greater flexibility to integrate critical partners like Plaid, Twilio, DocuSign, Salesforce, Zendesk, Okta, credit bureaus, marketing technology, payroll providers, just to name a few. Galileo plans to build new products on top of Technisys' multi-product core to help customers expand outside of deposit accounts and debit cards, including secured and unsecured credit cards, rewards, and lending as a service, just to name a few. In fact, Galileo is already a Technisys customer, having begun building a lending as a service offering for its partners on Technisys' core. The third synergy, Galileo will benefit by selling into Technisys' customer base, and it will appeal to a broader array of new customers. Technisys has 60+ partners spanning traditional banks, neobanks, and non-financial brand companies. Galileo can leverage these existing relationships to offer processing and the many new products in the development pipeline. Having full stack capabilities, from UX UI development capabilities to an extensible multi-product core and processing, will help Galileo to drive growth beyond a leading position with neobanks into new segments, including established banks, non-financial brand companies, and even greater appeal to enterprise companies. The fourth synergy is Technisys and Galileo are expected to realize synergies by going to market together to drive new partners' adoption and leverage each other's strengths and complementary geographies. We believe the combination of Galileo and Technisys in one complete stack will unlock entirely new customer wins in a joint go-to-market strategy to further penetrate established banks, fintech companies, non-financial brands, and enterprises. In addition to the combined offering being more differentiated to serve all segments, both companies will leverage the scale of each other's strongest markets that are complementary. The combined company will add 12 markets of operation for a total of 16 countries. Technisys' revenue is largely derived from LATAM markets, with a recent number of US-based companies adopting its technology, while Galileo's strength is primarily in the US, with emerging success in Mexico and now Colombia. So we're super excited about the opportunity to continue executing on our overall strategy and the benefits that Technisys provides for that strategy. In summary, the transaction strengthens SoFi's ability to execute our FSPL strategy to build best-of-breed products with superior unit economics, while building an even more robust technology platform on a path to creating the AWS of FinTech.
All the key points discussed by Anthony Noto seem to justify the company's acquisition. But why acquire Technisys in an all-stock transaction? According to Investopedia, a stock-for-stock transaction like the transaction entered by SoFi in its Technisys acquisition is cheaper and more efficient because the acquiring company does not have to raise additional capital for the transaction, and a stock-for-stock transaction is less expensive than the process of traditional mergers. Anthony Noto's a pro. After all, he has worked in the finance space for over a decade. Last December, SoFi announced the completion of the redemption of its 20,124,963 public warrants and its 8 million private warrants that were outstanding as of the closing of the business combination, resulting into the following. 6,264,922 public warrants were exercised for cash at an exercise price of $11.50 per share of common stock, and 13,193,604 public warrants were exercised on a cashless basis in exchange for an aggregate of 11,027,668 shares of common stock. That's a mouthful, which represents around 96.7% of the outstanding public warrants, meaning around 3% of its total public warrants were not exercised on or before its redemption date. 2 million private warrants were exercised for cash at an exercise price of $11.50 per share of common stock, and 6 million private warrants were exercised on a cashless basis in exchange for an aggregate of 4.166 million shares of common stock, which represented 100% of outstanding private warrants. In its press release, SoFi noted that it had generated a total cash proceeds of approximately $95 million from the exercise of these warrants for cash. It further noted that SoFi, as of the redemption date, had no public warrants or private warrants outstanding. If you're still watching this video, comment 95 million cash proceed down below and automatically get shouted out in our upcoming videos for sticking around until the end. The exercise of warrants leads to a company issuing new company shares, which leads to dilution, thereby decreasing our shares' value as an investor. A greater number of shares available to the public means a chance of generating a lower earnings per share, which can be expected of startup companies, especially early on in their life. When Anthony Anthony Noto says they are reinvesting 70% of SoFi's revenue back into SoFi, he is dead serious, and it's definitely more clear now than ever. Stock dilution is expected in a startup company, and SoFi is no exception. But considering their Technisys acquisition will enable them to be like the AWS of the fintech space, seems like a pretty fair trade for a brighter future. That wraps up today's video, guys. Let us know what you think in the comments below, and until next time, peace.